So page 8 of one of the glossies, called Negative Gearing and Capital Gains Tax Reform. Do you know about this one? 8-page glossy from Budget Night with a few examples. Yeah?
I've got a tax explainer that's
yeah. So there's an
8 pages long. Yep.
Yeah, there's an example from Jack, right? So Jack has a taxable income before capital gains of $25,000 in 2930, realises a capital gain of $10,000 on an asset he purchased in 2728. He doesn't receive the income support payments, so he's not exempt. And so the tax on his gain of $10,000 is $1,400, or tax rate of 14%. As it's lower than 30%, Jack pays an additional $1,600 in tax to bring the tax rate on his capital gain to 30%. So Jack is worse off, isn't he?
Before we continue, do us a little favour by subscribing to the channel, because over 98% of you watching haven't subscribed. It costs you nothing, not even a penny, to join this channel. Have you subscribed? Thanks so much.
Well, I think we continued. There's tax offsets, so you need to look at it in totality. There's tax offsets. So Jack, just looking at the scenario again. Jack may have got the WATO. He may have the instant tax deduction. But we also indicate if he received income support, he would be exempt from the minimum tax.
But he's not exempt. So he pays the minimum 30%. It says here. So for low income these are not tricky questions. The question is there are going to be low income people that make capital gains that are going to be worse off, isn't there?
So I think in the example we've given the statistics that show he pays an additional $1,600 in tax.
Yeah, so he pays more tax. Okay, thank you. Now look, there's been a lot written about the way this is all going to play out. So it looks like there's a lot of arbitrage, right? So effectively, if I'm a punter and I invest in a few shares and I make some gains and some losses, I can't net off the gains or the losses against one another, be they real or nominal. But if I'm an investment company and I'm going and buying a basket of shares, different companies on the ASX, the same companies, I can net off losses against gains and have a better tax position, can't
I? So I think we talked about that this morning with the Secretary, and Dr Johnson talked about it earlier as well, around the treatment of nominal losses. In the scenario that you talked about, we said there was a range of matters to trade off on, and...
Well, do you want me to ask the question again, given Dr Johnson's here? Okay, Dr Johnson, how are you?
I'm good, thanks.
Nice to see you. So, if I'm a punter and I buy a couple of shares in the ASX in my own name, right, some make gains, some make losses. Let's say, for argument's sake, some are nominal losses, some are real losses. And then over here I've decided to buy a unit in a managed fund, right, and that happens to invest into the same ASX listed shares. In that case, the manager can net off the losses against the gains for tax purposes, can't they?
So even the individual can offset losses against capital losses against capital gains?
All losses, nominal and real?
So the system, so like I mentioned before, the system uses nominal losses. That's tax system integrity, protecting the tax system. But you can offset your losses against your capital gains. So if you have a share, you get a gain. You've got another one with a loss. You can offset the loss that you've calculated with the capital gain that you've calculated as well.
So there's no. So you don't think there's any arbitrage here that would favour an intermediated approach?
Like I said before, this is the same approach that applied for 15 years when CGT was first introduced. It's also consistent with the arrangements that applied in other countries that have similar arrangements.
So what if I make a real loss?
So like I said, the gains, the way the losses are calculated, they're calculated on a nominal basis, and that's for tax system integrity.
What if I make a real loss as an individual shareholder versus a shareholder, a person who has invested in a unit in a managed fund?
if you've made a real loss, it would be capped at the nominal loss.
Capped at the nominal, so you could be worse off in that example.
Well, I mean, that would depend on a range of factors. So
No, I understand that, but we're just trying to work out, like, this is budget estimates, right? You've put a massive new tax plan on the table. We're trying to work out where the wrinkles are. That's our job. So,
Well, I think
my understanding...
You worked out that day one when you came out arguing against all aspects of it.
More politics, eh?
Hey?
I'm trying to do my job and you're doing politics again.
Oh, come on, Senator Bragg. Honestly. The man that never smelt a political line in his life. Like, we'd all believe that if we didn't know you, Senator Bragg.
Come on. This is silly. So, the your real losses, if you make a real loss and you're a listed investment company, then your real losses can be netted off. But if you're a punter, you can't.
They also use nominal losses as well. So the system's based on. So if you're operating through a company that's based on a nominal system.
Yeah. So if I make a real loss as an individual shareholder, it's gone.
Well, if you make a real loss, you'll get
You said it was nominal. Was it real or nominal?
No. So, sorry, you just mentioned if I make a real loss, and I was just going to say that if you make a real loss, it would be capped at a nominal. So you can only get nominal losses.
Yeah, yes, it's capped at nominal. So you might pay more.
But you can use your nominal loss against a real gain to offset it.
Yeah,
that is totally fine.
But it is clear that, like, there are certain structures here which are advantaged here. It's very clear to me. So
asymmetric treatment of losses.
If you're in a family trust, or you're a punter, or you're a small business, or you're a company, you're looking at a 30% rate in most cases. Companies don't pay capital gains, but if you're a person or a small business or a trust, you're up for 30%. But if you're a super fund, you're only up for 10%, aren't you?
You get a super fund that's eligible, and providing they've held it for long enough, they'll get a 1/3. A super fund that has held the asset for long enough will get a 1/3 discount.
10%.
Yeah, so it could get their rate to a 10%, but it's a 1/3 discount.
10%.
A 1/3 discount. Yeah.
10%. So it's a bit like the Animal Farm, George Orwell. There's some people are more equal than others, and so you could have a super fund then deciding that they will then go and invest in the same shares as the person, and they pay 10% CGT, whereas the person pays 30%, right?
You're at 8 minutes, Senator Bragg.
Sorry, can you I couldn't quite get that one, sorry.
Okay. So...
And we have already made changes to super tax concessions this term, just to remind you.
I'm sure you've helped the super funds as much as you can. That's a high priority for you.
You opposed our...
You loved it. This is one of your favourite things.
You opposed the changes we made to high balance super accounts, Senator Bragg, just for the record.
Okay, so...
You're at 9 minutes.
Sorry, I think
Bragg.
Dr Johnson wants me to repeat the question.
Okay.
Maybe I've been inarticulate.
Well, and
I apologise.
I just preface it by saying it is very difficult to ask Treasury to give tax advice on the spot
advice? Chair, come on.
Well, about situations that you're dreaming up on the spot.
I'm dreaming them up.
Yes.
Come on. I know it's late.
Yes, you are.
But we're talking about the economy. You're putting this wrecking ball through the show. Right?
We don't.
Individuals are going to have to pay 30%.
Senator Bragg.
Small businesses,
we
trusts,
don't agree with that.
And you've carved out your best mates who only pay 10%.
No, we're making some sensible tax reforms. I accept you don't agree with them, but I don't think you need to carry on like that.
I'm not carrying on. Dr. Johnson has asked me to rephrase the question, so I'll do it again. So, if I am a person and I invest into BHP shares, right? Any person in Australia now, unless I'm exempted.
Canberra was thrown into another fierce economic showdown this week, and this time the battleground wasn't immigration, housing or national security. It was Australia's tax system. What started as a detailed budget estimates hearing quickly turned into one of the sharpest exchanges over capital gains tax reforms yet, as Senator Andrew Bragg challenged Finance Minister Katie Gallagher and Treasury officials over one simple question that refused to go away. Why should two Australians making the same investment gain potentially face different tax outcomes? It sounded like a technical tax discussion at first, the sort of conversation most people would expect accountants and Treasury officials to have behind closed doors. But within minutes, it became something much bigger, because behind the complicated language sat a question millions of Australians can understand. If two people invest in exactly the same asset, should they be paying different amounts of tax simply because they hold that investment through different structures? That was the issue Bragg kept returning to throughout the hearing. Armed with examples from the government's own budget documents, he began walking Treasury officials through practical scenarios involving ordinary investors, managed funds, trusts, and superannuation funds. Rather than making broad political attacks, he focused on individual examples, repeatedly asking officials to explain how the proposed reforms would work in real life. The exchange immediately became tense. Treasury officials explained that Australia's capital gains tax system already treats different investment vehicles differently in certain circumstances. They argued that some of those arrangements have existed for many years and are not unique to the latest reforms. Existing concessions, discounts, and different tax treatments already apply depending on the type of taxpayer and how investments are held. But Bragg wasn't challenging the history of the tax system. He was challenging what happens next. He argued that under the government's proposed reforms, new minimum tax arrangements could produce significantly different effective outcomes depending on who owns the investment. Again and again, he returned to examples involving ordinary Australians investing directly, compared with institutional investors or superannuation funds investing in similar assets. That distinction became the centrepiece of the hearing. For Australians watching outside Parliament, the discussion may have sounded technical, but the implications are anything but. Millions of Australians invest directly in shares, either to build wealth, save for retirement, or supplement household income. Others invest indirectly through superannuation funds or managed investment vehicles. The way those investments are taxed can influence long-term financial planning, retirement savings, and investment decisions. As Bragg pressed further, he argued that consistency matters. If the same economic gain is being generated from the same underlying investment, he questioned whether significantly different tax outcomes create unnecessary complexity or distort investment behaviour. Treasury officials responded that different structures have long been treated differently under Australian tax law and that the government's reforms build upon existing principles rather than introducing an entirely new concept. Minister Gallagher soon entered the debate. Rather than focusing only on the technical examples, she defended the government's broader reform agenda. She argued the proposed changes form part of a wider effort to modernise Australia's tax system, improve fairness, and address housing affordability through a package of complementary reforms. From the government's perspective, the opposition was isolating individual examples while ignoring the broader objectives of the legislation. Bragg strongly rejected that characterisation. He argued that examining individual examples is precisely the role of budget estimates. Parliament, he suggested, has a responsibility to understand exactly how legislation affects different taxpayers before voting on major reforms. If practical examples reveal inconsistencies or unintended consequences, then those questions deserve answers before laws are passed. The atmosphere inside the committee room became increasingly lively. At several points, exchanges between Bragg, the minister, and Treasury officials overlapped, as each side attempted to clarify the examples under discussion. The chair repeatedly intervened to keep proceedings orderly while allowing officials to complete their answers. Despite the interruptions, Bragg continued returning to the same central question. If an individual investor and another investment vehicle hold comparable assets, why should the effective tax outcome differ? Treasury officials maintained that many of the differences highlighted during the hearing already exist within Australia's tax framework. They explained that superannuation funds, companies, trusts and individual taxpayers have historically operated under different taxation arrangements. In their view, the examples being discussed reflected long-standing features of the tax system rather than entirely new principles introduced by the government's latest package. Outside Parliament, however, the debate quickly gathered momentum. Tax specialists began analysing the hearing. Business commentators discussed whether the proposed reforms could influence future investment decisions. Financial advisors examined the practical implications for individual investors, while economists continued debating the broader objectives of Australia's capital gains tax system. Social media quickly joined the discussion. Supporters of Bragg argued he had exposed important questions about fairness and consistency that deserved further explanation. Supporters of the government argued the opposition was focusing narrowly on selected examples while overlooking the broader purpose of the reforms. Others suggested the hearing demonstrated just how complex modern tax policy has become and why careful parliamentary scrutiny remains essential. The timing made the debate even more significant. Australia continues grappling with housing affordability, productivity challenges, business investment and long-term economic growth. Tax reform inevitably influences all of those issues because taxation affects investment decisions, savings behaviour and capital allocation across the economy. Every adjustment carries potential benefits, trade-offs and unintended consequences. International comparisons also entered the broader conversation. Many developed economies continue reviewing capital gains taxation as governments seek to balance investment incentives with revenue needs. Different countries adopt different approaches regarding inflation, holding periods, investment vehicles, and retirement savings. Australia's debate reflects a much larger international discussion about designing tax systems that remain competitive while supporting long-term economic sustainability. Back inside the hearing, neither side backed away. Bragg insisted Parliament should understand every practical implication before major reforms proceed. Gallagher maintained that the government's package represents responsible tax reform and argued previous governments had also accepted different tax treatments across different investment structures. The disagreement highlighted two fundamentally different political approaches. One side argued that reform should prioritise consistency, simplicity, and certainty wherever possible. The other argued that tax policy inevitably involves different rules for different taxpayers because economic circumstances, policy objectives, and existing legislative frameworks vary considerably. Reasonable Australians may disagree about which philosophy is preferable, but almost everyone agrees that taxation affects everyday life. It influences retirement planning. It shapes investment decisions. It affects business confidence. It helps determine where Australians choose to save, invest, and build wealth. That is why debates like this matter far beyond Parliament House. As the hearing concluded, neither side claimed victory. Bragg maintained that unanswered questions remained regarding how the reforms would operate across different investment structures. The government maintained that Treasury had already explained the policy framework and that Australia's tax system has always recognised distinctions between different categories of taxpayers. The political debate, however, is only just beginning. As legislation continues moving through Parliament, business groups, investors, financial advisors and tax professionals will continue examining every detail. Amendments may still be proposed. Further scrutiny will almost certainly follow. And Australians with investments, whether held directly or through superannuation, will be watching closely to understand how any final legislation could affect them. This week's hearing demonstrated exactly why tax reform remains one of the most challenging areas of public policy. Behind every percentage point sits a real person. Behind every legislative definition sits a financial decision. And behind every parliamentary exchange sits a broader debate about fairness, growth, and Australia's economic future. So what do you think? Did Senator Bragg raise important questions about consistency within the tax system? Has Minister Gallagher adequately defended the government's reforms? Should Australians making similar investment gains face similar tax outcomes, or are different rules justified for different investment structures? Share your thoughts in the comments below. If you enjoyed this breakdown of Australian politics, don't forget to like the video, subscribe to the channel, and share it with friends and family. With major economic reforms continuing to move through Parliament, there are certain to be many more political battles still to come.